Welcome to this module on income and expense accounting in the UAE. In this course, we'll walk through how revenue is recognized under International Financial Reporting Standards or IFRS and how these rules interact with the UAE's new corporate tax regime. We'll also explore expense classifications, identifying which expenses are deductible, which are restricted, and which are disallowed altogether. To make it practical, we'll link each area with example journal entries so you can see exactly how compliance translates into accounting records. Finally, we'll close with a compliance summary giving you the key points to ensure that your financial reporting and tax submissions are accurate, consistent, and audit-ready. Income recognition in the UAE is governed by IFRS 15, which requires companies to apply a structured 5-step model. Let's take a service company as an example. Identify the contract. Example, a client agrees to pay 100,000 dirhams for an annual software license. Identify performance obligations. Here, the obligation is access to the software for 12 months. Determine the transaction price, 100,000 dirhams. Allocate the price, all allocated to the single obligation. Recognize revenue as obligations are satisfied. In this case, revenue is spread over 12 months, not all at once. In accounting terms, at the start, debit accounts receivable 100,000, credit unearned revenue 100,000. Each month, adjust debit unearned revenue 8,333, credit revenue 8,333. From a tax perspective, the UAE corporate tax generally follows IFRS income recognition. Small businesses with annual revenues under 3 million dirhams can opt for the cash basis, recognizing revenue only when cash is received, other than when it's earned. Now let's turn to expenses. To qualify as deductible in the UAE, expenses must be wholly and exclusively for business purposes. Typical deductible costs include salaries, rent, utilities, and marketing. For instance, when paying salaries, the entry is debit salaries expense, credit bank. Some expenses are restricted. Take a client dinner for 1,000 dirham. Only 500 dirhams is deductible for tax purposes, even though the full 1,000 dirham is recorded in the books. Certain costs are entirely disallowed. For example, if a company pays an administrative penalty of 20,000 dirham, the accounting entry is debit penalties expense credit bank. However, this expense is not deductible for corporate tax, so it must be added back when calculating taxable income. Similarly, donations made to a local but non-registered charity would be recorded in the accounts but disallowed for tax. Understanding this distinction ensures accurate reconciliation between financial reporting and tax filings. Although accounting standards and tax rules sometimes diverge, they must ultimately be reconciled. A good example is the client dinner case. Accounting records the full 1,000 dirham as an expense, but the tax computation allows only 500 dirhams. Another example is provisions. Under IFRS, companies may record provisions for doubtful debts or warranty obligations. For tax purposes, however, these may only be deductible once actually incurred or written off. That's why disclosures in the financial statements are so important. By clearly presenting income and expense treatments, auditors and tax authorities can see how numbers reconcile. Finance teams should therefore run dual reviews, one focusing on IFRS compliance, the other on UAE tax adjustments to ensure both sets of requirements are met. To summarize, income must be recognized under IFRS 15 unless you are a qualifying small business allowed to use the cash basis. Expenses must be wholly business-related to qualify as deductible. Restricted or disallowed costs such as entertainment beyond 50%, penalties, or non-approved donations must be adjusted in the tax computation. The key to compliance is discipline in bookkeeping, proper journal entries, reconciliations between accounting profit and taxable profit, and supporting disclosures. With these in place, UAE businesses can remain both compliant and audit-ready.